What's up, everyone? Welcome back to another episode of Financial Finesse. I'm your host, Jabari Elliott, and today we're going to discuss 5 ways to make money in a down market. Given what's currently going on in the stock market, I figured this video would be helpful for those trying to figure out strategies for when the stock market goes bearish. And with that, let's get started. Number 1. Actually, before we get started, please go ahead and hit that like button. And if you haven't already, subscribe to my channel and hit that notification bell so you can get alerted to any future videos. Number 1, buy good stocks at bargain prices. While a bear market usually means stocks of both good and bad companies tend to go down, bad stocks tend to stay down. Almost always, good stocks recover and get back on track to growth. And if the stock price of a good, profitable company declines, then a buying opportunity is presented. With the entire motive behind stock investing being to buy low and sell high, bear markets provide the best chance for flipping stock purchases. But patience is important here. Regardless of what might be said, no one actually knows when a bear market will reverse. Therefore, it may be beneficial to spread out your investment over the course of the bear activity via dollar cost averaging. Simply put, you want to purchase your shares in small allotments over time versus one large buy of multiple shares. This will ensure you pay an average cost for the stock during the bear period so that when the bull returns, you'll be ready. Number 2, search for high yield dividend stocks of profitable companies. Because dividends are tied to a company's net income and not their stock price, they still have the ability to share profits with investors during bear periods. If the stock price declines and the company remains strong, it may represent a good buying opportunity for those investors seeking income. For example, say a stock is $100 and that company pays an annual dividend of $3 or a 3% yield. In a bear market, if that stock falls to $50, but the dividend remains at $3, one can gain the same dividend value, but at half the price. If you want to know more about dividends, make sure you check out my video on income investing, and make sure you smash that like button so we can reach as many new investors as possible. Number 3, focus on defensive stocks. Different sectors perform well during different times of the economic cycle. This includes companies in the food and beverage industry, as well as utilities. For most investors, this will be considered a safe investment. However, for those a tad bit more skittish like myself, sector ETFs may be a better option. ETFs are a good way to add diversity while using the sector rotation approach described here. And because ETFs are a basket of securities, you can still benefit from the movement of a sector or an industry without having to worry about picking specific companies. Number 4, short bad stocks. Shorting stock is the process of selling borrowed stock now, so stock you do not own, with the anticipated opportunity to buy that stock back later at a lower price, in which the investor will pocket the difference or pay the difference if they make the wrong call. In a bear market, when bad stocks go down, they can keep falling and provide an opportunity to profit when they decline further. When a company is losing money, losing equity, or getting over indebted, and their stock price goes down, it's usually more severe than average companies. Now, because you are betting that the stock price will go down, short selling can be very risky. Because the stock price can only decline to 0, but has unlimited room to grow upward, a short seller has the potential for unlimited losses. For those more risk adverse, an inverse ETF may be a better option. Inverse ETFs use short selling, trading derivatives, and other leverage investment techniques to perform in the inverse of whatever industry or index they are tracking. Inverse ETFs basically do the short selling for you, but without the same risk as short selling yourself. Which brings us to number 5, buying put options. Like short selling, put options are a bet that the underlying stock or ETF will fall in price. Many investors speculate when attempting to use puts for profit. However, they can also be used to hedge other investments. Unlike short selling, you can limit the amount of risk you are willing to take with put options. When holding a stock long term, investors may also purchase a long put option in case that stock price starts to fall. This acts as insurance in case an investment moves against you. In a bear market, put options can provide a lot of value outside of just hedging other investments. Like the short selling strategy, put options for profit should focus on companies with poor financial outlooks. However, unlike short selling, put options have a finite amount they can lose when bought to open. Comparatively, this means put options carry lower risk than short selling. So that brings us to the end of the video. I hope you enjoyed it. Please like, comment with what you would like to see next, subscribe, and make sure you hit that notification bell so you'll be alerted to all future videos. And as always, keep finessing.